It's 11 o'clock. I think we'll get going. Thanks very much for tuning in again. So this week's special guest is Stephanie Soroto of RTW Venture Fund, who we last talked to, I think, about 18 months ago. So it's going to be quite interesting to see how that fund's been getting along since. In terms of news, still not a lot. I'm hoping that things will get going quite soon, but nevertheless, we did have not results per se, but more of a sort of roundup of the year from Ruffer, and I think that's quite interesting. So I was sort of going to town on that, and then Octopus Renewables said something about its dividend this morning, which I think is probably worth mentioning. So Ruffer did all right actually last year. So an NAV return of 8%, which compares to a fall for the MSCI or Countries World Index of 8.1%. So definitely quite good news. Share price return not quite matching that, 7.3, but still not bad. And probably not surprisingly, on the back of what was going on, people were sort of chucking money at the fund, and it went through $1 billion market cap. And we've been working on sort of producing our annual report. I think it's going to be out soon, maybe early next week. And Ruffer, I think, was probably one of the companies that raised the most amount of money last year, which is not bad. And compared to other funds that are trying to do similar things, it sort of dwarfs them in terms of returns. So this is not looking for the calendar year 22. The numbers I've got here just run to last night. They're just taken straight off the QuotedData's system. But basically, it outperformed personal assets, which outperformed Aberdeen Diversified Income and Growth, and then capital gearing, JP Morgan multi-asset, Invesco perpetual balanced, Momentum multi-asset, and then RIC Capital Partners down at the bottom. It's really quite a big gap between it and personal assets, and that's because it is doing slightly different things, and that has made a big difference. And there is its long-term returns, actually the returns since launch relative to the all-share index that we just lifted straight from their thing. You know, we don't normally use all-share when we do our stuff, but we've just copied this. And that works out a return per annum of about 7.8% a year, which is really not bad, I think. It just shows you that even though you're missing out on sort of big jumps in markets, over the long term, it does work out that you're making money. As they make the point, there was really nowhere to hide last year. So this chart, what it's trying to do, each individual bar represents a quarter, and it's the best performing asset class for that quarter. So what we're saying is, for 3 quarters in 2022, every single asset class lost you money, and even the best one, you know, was losing almost 5% in the first couple. Things were made up for it at the final quarter of the year, and that's really, I suppose, triggered by the fall in US inflation, and hope that things will sort of normalize a bit. But I think that might be early days. We're going to find out. So, as I said, it does different things to the others, and the big driver of returns over 2022 was its interest rate hedges. So it's making bets against interest rates rising. Against interest rates falling, sorry, the other way around. And that added 7.3%. And then it's also been going short on equities. So sometimes a basket, sometimes an index, sometimes individual stocks. And different things worked at different times. It's got a whole portfolio that are dedicated to doing this. So there's tech stocks in Q1, European banks in February, and then things like Tesla, which we know has had a really terrible year. And then the S&P 500 in the second half. The credit protection stuff, so basically credit default swaps, adds another 2.5%. Again, that's something that most of the competition aren't doing at all. And that would have been even better, but for things went the other way in the second half when suddenly that US inflation number came in quite good. And the remarkable thing really is over the piece that its equity positions actually went up 2%, which against to say an 8% fall in markets is really quite impressive. And that just comes down to stock selection, and they're very, very selective about what they've got. The traditional things that you'd hide in, things like gold, didn't work, and neither did the index-linked gilts that they've got. They want to hang on to these though, even though they cost them 5%. They've been trading them. And if you look at these are sales, these are purchases, first graph, you think that, oh, actually, this didn't look rather clever. But the really big thing, I think, was that when the mini budget happened and these things just collapsed because the yields spiked out, they bought quite a lot, and the money they've made on that really made up for everything else. So that overall, that trade pattern over the second half of the year added 1% to the returns. And these are interesting deals. They're trading because they trade relative to interest rates too, just like normal bonds do. So even though the inflation part of the bond is working, the sort of bit, the bond part of it isn't really working. It's got very low equity exposure. I think that's the main difference between it and then something at the other end, like MATE or the Men's Passive Value. It's got much lower equity exposure than many of these other funds. And they are expecting a slightly odd period to come as we go into 2023. So they basically think markets can be fooled into thinking that inflation is conquered and get overexcited and then get caught out again. And the main reason why they think inflation is not going away is because we've had this long run trend of globalization where you can keep shifting manufacturing to cheaper and cheaper places and just in time and everything else. And then it stopped working, and people are now putting more redundancy back into the system, and that's adding to costs. So shortening supply chains, moving manufacturing back on shore, obviously with higher wages, all of that stuff means that inflation is going to be quite hard to tame. And they do think it's just going to be more volatile. They also expecting that central banks won't be as able to resist calls to support economies as they might have wanted to be. So as the recession starts to bite, that they'll be urged to ease up, and that will let inflation back into the system again. So basically, we're moving to a much more volatile period for inflation. And that underneath all of this, the big investments that governments need to make in things like preparing for climate change are going to increase the fiscal deficit. So there's just going to be more money swirling around. So they're saying that we could see this volatility in inflation for about a decade. And that is backed up with this chart here, which basically says for individual countries that where their inflation hit 5%, how long did it take inflation to go back down towards 2% again? And for the most part, it's like at least sort of 5 or 6 years. So around a decade in, it's about sort of average, which makes perfect sense, I suppose. They also worry that equities earnings estimates are a bit too high. And this is sort of like a long-term trend. They don't really know the answer to this, though, but it's something that they're sort of concerned about in the back of their mind. There are reasons why they think earnings might continue to grow, and it might be they're saying that earnings continue to grow in nominal terms because of inflation impact, but actually real earnings may not grow at all. So if things return to trend, then markets are going to still look expensive and equities are going to fall off. If they don't, then maybe they're going to be okay, but it's hard to tell. So at the end of the day, this is how they've positioned the portfolio. So in terms of the sort of growth side of things, trying to capture the upside in economies, there's really almost nothing there. And that's this chunk here. It's much more about protecting the downside still. And it's going to be interesting to see how 2023 plays out and whether they've got this right or not. Obviously, if they're over defensive, then some of those other funds that were lagging it last year are going to catch up and overtake it again. But if they're right, then it's going to be another great year for Ruffer, and we'll just have to see if they actually manage to make the same sort of return as they did last year. Octopus Renewables. I wanted to mention this just because if you are worried about inflation, you are looking for alternative assets and things that might be a better home for your money. Apart from things like Ruffer, the renewables still look like they are working. So it's just announced another dividend hike for 2023, which is at least matching inflation, which is what it's setting out to do. So 10.5% increase in the dividend to 5.79p is really not bad. And it's a relatively new fund, so it's just sort of getting going. And that's helping, but it does also help that over half its revenues are implicitly inflation linked, so that it's got a natural flow through of revenue coming from inflation linkage. So it's saying, yes, we're going to hike the dividend, and we reckon we can do that and cover it from cash flow as well. We're not paying it out of capital, which some of the other funds that have struggled to get their money deployed have been doing. So I do think that this, is actually quite a decent investment now. Yeah, and it's a big sort of relatively liquid fund. It's still trading now on a 13.7% discount. I think this, the panic that hit the renewables market about rising discount rates, I think it's hard to tell, but if interest rate rises are moderating, I do think that pressure is going to come off, and I don't see really why these things shouldn't be trading at asset value and back in premiums again, because the yields aren't bad, really. 5.5% based on last year's dividend, 6.1% prospective. So on that basis, then I think these things are okay. So that's me.